A lot to talk about today. We had a 2-day bounce so far off of this high premium dark pool range. We referenced this in our weekly recap video. The range is roughly 374 to 380 on SPY. And as of now, it's had a very positive reaction to this level, or at least this range. And so far we are above it. So especially if the weekly can close above, there is a potential at the very least we have a retest of this line right here, which is the line that goes to 2020 lows. And you can see here it connects to the June 17th low. I've referenced this a lot in our videos, which you probably already know if you're subscribed. And if you're not yet, you can subscribe below. It is free. And this would not be out of question to see a retest of this line because it is such a crucial line that we broke through. And typically when you break through a critical line, whether it be to the upside or the downside, in this case it's downside, you tend to have a retest in the future of that line because price just likes to retest it and make sure that it actually broke through and it's confirmed that there is, in this case, a new downward trend, kind of like it seems to be right now. Otherwise, it could get back above and it would be considered a fake breakdown. But as of now, we still are below, and I suspect that we will have some form of a retest coming up here, at least in the low 390s. Something to keep note of, especially with bullish seasonality coming up, kind of like that Santa rally period. There's a potential that you could see a little bit further price discovery into the low 390s. So I wouldn't keep that out of question. There's a lot of shorts that added once we had confirmation before. If you remember here, the weekly closed below this critical line, and it's a very bearish weekly candle. Like, look at this thing from last week. Very bearish overall. We had a high wick up here from CPI, and then we also had FOMC and everything. I mean, then we collapsed straight off of that to close below with a lot of volume backing it. So as of now, this is a bearish setup going forward, but it's not a surprise to see a slight relief bounce, especially off of low volume in a seasonally bullish period. Along with that, we also had a few bullish bets today that were pretty unusual. We had a $1.2 million 395 strike, so this was quite a bit out the money, as well as a $1.6 million 386 strike, so this was at the money. Then we also had the 1.0 million for 377, which was in the money. So these are very unusual. All these were, as you can see here in order details, they were above the ask. And it was actually weird because today we didn't see a lot of bearish emphasis. Now, yes, it says 70% put flow to 30% call flow if you filter for over 500,000 in premium. However, if you look through it, a lot of these are the super deep in the money puts that we're seeing. And personally, I don't take these into account for my analysis. I don't find them that useful. So I kind of like check them out and then I just look at the more useful prints. This one here could be a little bit more useful, but again, this one is a little bit further in the money. So I personally don't see that much directional bias compared to something like this where you see out the money put or out the money call in this case for a 1.2 million in premium for 395 strike. And it's also a pretty close expiration. So these were more useful in the past couple days, such as Monday and Tuesday of this week, even Friday of last week. We saw a ton of puts that were out the money, and it's no surprise that we have fallen since those days. But you can see here on Thursday of last week, Friday, and then also Monday, we saw a lot of those puts, but now it seems like it's having a form of a relief bounce, and we had some call flow to supplement that move up. So it seems like that downside, at least in the very near term, has kind of subsided. And if we do see a reemergence of those puts, then there's potential for an additional leg down from here. So I'm going to be watching for those as we kind of have this relief rebound to the upside, because if we do see a lot of those puts like we saw back up here from last week around Wednesday, Thursday, and Friday, that can give us insight of potential short opportunity, especially if it's around that retest range I was talking about, because that could lead to some more downside. Additionally, speaking of retest, Apple is in the retest range right here of this pennant formation. This is a critical level, guys. You want to make sure that you check what happens with this weekly candle coming up here on Friday, because if the weekly candle closes yet again below, because remember, if we go back here to the weekly candle, we closed below the pennant as of last week. And not only that, it was confirmed we had some volume to support the move down, plus a weekly candle below a key trend line like this shows confirmation of further downside. Typically, the only way the bulls are getting out of this one is if we have a weekly close back in this pennant. So we have to get above roughly 137, 138 to close out the week, because then this would be a form of bear bait, which I've referenced in the past. That's kind of when you have a bearish setup like this, where you see confirmation in a candle like a weekly candle below a certain level, but then the following week it goes right back up into the pattern, and then all those bears that shorted with the confirmation get squeezed out. And then you also see a lot of buyers in this range just because it showed a lot of demand, and then you kind of squeeze out of that segment from there. So that's something that I personally am not expecting to happen, but something that I'm watching, because again, Apple is the largest holding in the market, and if it stays below this key trend line, or at least below the pennant, that could lead to some more downside, and also will have an impact in the general market like the S&P 500, and especially in tech for QQQ. Also, if you remember from our weekly recap video, I referenced this downward trend line on the Dow Jones. We had a perfect retest retest and bounce, which has brought a lot of strength to the general market because of this retest right here. Now, you also have to remember we are in a head and shoulders pattern, as you can see here from this past month. So 34,000 is a key level to watch, because if you can get above that line, that's kind of what we consider the neckline of this head and shoulders pattern. If you get above that, then you probably see some form of a squeeze in the Dow Jones, and that would relate to the rest of the market. As of now, it is still above the key downward trend line, but it's also in a head and shoulders pattern. So it's likely to stay stagnant in between this range. And if we do get confirmation, which I expect to happen in Q1 of 2023, confirmation below the downward trend line, that could be a viable short opportunity, at least in not only the Dow, but also the S&P 500, because the Dow has given the S&P 500 a ton of strength on this past rally. You can see here it broke out of its downward trend line, which was the only index to break out of its own downward trend line, because a lot of the other ones have been lagging in comparison to the Dow, and the Dow showed just a lot of strength overall. So if it does break below this, which I expect in the future, that will bring more downside to the entire market. So I am watching Dow's chart. It can give us a lot of insight. So do mark this downward trend line on your chart. These would be very beneficial to reference in the future. Also on top of that, we have Microsoft here, which had another retest of its own downward trend line that it broke out of. However, this retest seems a lot weaker than its first one. This one was a little bit stronger because obviously it was the first test, and typically the first test of a key support is always going to be the strongest. However, also it was in a more bullish formation when it was touching this. Over here, we had a fake breakout above this 255 to 256 level, which was the previous high of this move. We had a fake breakout. It was not able to hold above very long, so fell back down. So this seems like it's just having kind of like a short relief bounce off of this and will likely fall back below in the future. So something to watch. Lastly, I want to talk about the VIX here. We've seen a lot of weakness on the VIX for the past couple months now. You could see it was red day after red day after red day for a very long time. And then recently we had a nice relief bounce here, which also was a breakout of this downward trend line that I'll draw here roughly. You can see here it broke out on December 6th, this downward trend. However, it was rejected very hard off of this yellow trend line, which is the one that I've shared before. This one started on November 4th of 2021. You can see here it acted as support in January of 2022, acted as support in April of 2022, and then yet again started the kind of like the big downtrend we had in August of this year in the S&P 500, started its own uptrend because it works inversely to the S&P 500 for the most part. You can see here it started in August, or at least mid-August of 2022, before this big upward trend. And as of now, we've fallen below this key level, retested it, showed a lot of weakness off of it. So it looks like it's trying to make a new low of this move to get us below 19, because you can see here we've not only been rejected off this line, we fell below this support of 2267, and then also as of today we fell below this blue line right here, which was another key support on the way down that acted as support back in August. So we fell below all of these, showing a lot of weaknesses now, and it doesn't seem like, at least for the rest of the year, we'll see a large spike in the VIX. Potentially something that could happen in quarter one or quarter two of 2023, but right now it looks like risk off for the most part.